Okay, so let's start a new topic. Our new topic now is called reconstruction. Now, a company, let's call it company A. Company A has been making losses over a long period of time. So when this company has been making losses over a long period of time, it becomes difficult for that company to do what? To pay dividends. It becomes difficult for that company to pay dividends to their shareholders. It also becomes difficult for that company to attract potential investors. It is obvious there is no investor who would want to buy shares in a company which has been making losses, So for you as a company, if you are such a company, what is the most logical thing for you to do? The most logical thing for you to do as a company now is for you to reconstruct yourself, is for you as a company to reconstruct yourself. Now, the aim of reconstructing a company, why should we reconstruct a company? The aim of reconstructing a company is to help that company to eliminate their accumulated losses, Which means from now, we don't want to be reflecting losses in the books. Why? Because there is no investor who would want to buy shares in a company where they are seeing retained losses every year. So the aim of reconstructing the company is to help the company to eliminate the accumulated losses from the books of the accounts and to enable that company now to start its activities in a more attractive and profitable manner. So that is the aim of reconstructing a company, that we reconstruct a company with the aim of helping the company to eliminate the accumulated losses and to help the company to start its activities in a more attractive and profitable manner. So how then do you as a company reconstruct yourself? How do you then as a company reconstruct yourself? There are two ways in which a company can reconstruct itself. One way is what we call internal reconstruction. The second way is what we call external reconstruction. That a company can reconstruct itself either using what we call internal reconstruction approach or what we call external reconstruction. So let me go through each one of these approaches. Now, when it comes to internal reconstruction, when it comes to internal reconstruction, this is what normally happens. All the stakeholders of the company would normally come to a meeting and agree on a particular scheme of reduction. They would come to a meeting and agree on a particular scheme of reconstruction. Meaning, it is possible or it is required that all the stakeholders will be called into a meeting. For example, the ordinary shareholders, the preference shareholders, the debenture holders, so that we see who among them will be able to sacrifice. We want to see who among them should be able to sacrifice their amount of the capital so that we help this company to eliminate the losses. Now that means the stakeholders will tell us what they are willing to sacrifice in order to help the company to eliminate the losses. The stakeholders will tell us what are they willing to sacrifice from their part in order to help the company to eliminate the losses. For example, with the ordinary shareholders, are people we owe 20 million shillings, for example, they might tell us they are willing to write off 2 million from their capital. They are willing to write off 2 million. Maybe preference shareholders also, maybe as a company we owe them 30 million. They might tell us they are willing to sacrifice another 2 million or 1 million, whatever it is. The debenture holders, the same. Maybe we owe them, as a company, we owe them 50 million. And they are willing to sacrifice or to write off 5 million from their capital. So when it comes to internal reconstruction, all the stakeholders of the company will come up to a meeting and tell us what they are willing to sacrifice in order to help this company to eliminate the accumulated losses, to help this company to eliminate the accumulated what? To help the company to eliminate the accumulated losses. Okay? Now, I hope you can see from what we have just talked about that when it comes to internal reconstruction, effectively, it's like we are reducing the finances of the company, because we have said people like ordinary shareholders will tell us they are willing to sacrifice this, preference shareholders, they are willing to sacrifice this, debenture holders this much, and so on. So in other words, we are reducing the capital of the company. So when it comes to internal reconstruction, normally the major thing when it comes to internal reconstruction is capital reduction. That's what we are saying. When it comes to internal reconstruction, the major thing is capital reduction. Some books will even call this topic, some books normally call this topic capital reduction. They call it capital reduction. So that is the essence of internal reconstruction. That when it comes to internal reconstruction, all the stakeholders of the company are called into a meeting. They tell us what they are willing to sacrifice in order to help the company to eliminate the accumulated what? To eliminate the accumulated losses. Okay? We shall come back to that again. Now, we have also said there is another way of reconstructing a company, and that's what we called external reconstruction. That's what we called external reconstruction. Now, when it comes to external reconstruction, now, for purpose of illustration, let us assume company A is the one being reconstructed. Let us assume that company A is the one being reconstructed. So if company A is the one being reconstructed, and we want to reconstruct it using the approach called external reconstruction, then another company, let's call it company B, that company B could come and buy the business of the company being reorganized. Company B can come and buy the business of the company being reorganized. This company B could either be another existing company, or it could be a newly formed company, or it could be a newly formed company. Meaning, a company is formed so that they take over the business of the company being reorganized. They take over the business of the company being reorganized. So that's the approach we are calling external reconstruction. So when it comes to external reconstruction, another company must come in. Another company must come in so that they buy the business of the company being reorganized. They buy the business of the company being reorganized. Now, we want to move on now. We want to move on now to the accounting entries now. We want to go back to the internal. We want to go back to internal reconstruction. We want to go back to internal reconstruction. We want to go back to internal reconstruction. Internal reconstruction. What are the accounting entries for internal reconstruction? Remember, we have already said that the major thing when it comes to internal reconstruction is what? The reduction of what? Of capital. That is the major thing we have said in terms of capital reduction. In terms of internal reconstruction, we have said the major thing is capital reduction. And we have even said Some books will even call this topic a capital reduction. That's what we are saying. Okay. So let us assume now the question now, or when it comes to internal reconstruction, we were saying the ordinary shareholders might be willing to sacrifice. So number one entry is, in the books, we are saying when we are dealing with internal reconstruction, what are the accounting entries? Number one, with amount written off on share capital, with amount written off on share capital, whichever the share capital, whether it's preference share capital or ordinary share capital, what should be the double entry? The double entry for that amount should be, you will go to the ordinary share capital account. Let us assume it's share capital code ordinary. You will go to that share capital account, which I want to assume has a balance brought down of 20 million, which has a balance brought down of 20 million. Then we want to assume that this question tells you one share in that company has a par value of 10 shillings, meaning that the company has 2 million shares of shillings 10 each. The company has 2 million shares of shillings 10 each. Okay. So it could be the shareholders were willing to write off 2 shillings per share. The shareholders were willing to write off 2 shillings per share. Now listen. So if they are willing to write off 2 shillings per share, and our company had 2 million shares of 10 shillings each, and they are willing to write off 2 shillings per share, so it means they are writing off how much? We owe them 20 million. We called them into a meeting. They told us they are willing to write off 2 shillings per share. Our company has 2 million shares of 10 shillings each, and they are willing to write off 2 shillings per share. So they are willing to write off how much? Obvious, they are willing to write off 4 million. So we are saying with amount written off on share capital, whatever the amount is, with amount written off on share capital, we shall be debiting share capital. You go and debit that share capital account, and we shall be crediting an account we shall be calling capital reduction. You debit share capital with amount written off on share capital, you debit share capital, and you credit capital reduction. And if we are saying we are writing off 4 million, in our case, you will debit share capital by 4 million, and you will credit this account we are calling capital reduction. You will credit this account we are calling capital reduction, and you come and say your ordinary share capital, how much? 4 million. So that's our entry number one, which says with amount written off on share capital, with amount written off on share capital, you debit share capital and you credit capital what? Capital reduction. You debit share capital and you credit capital reduction. Okay? Listen to this again. There are times when in your company, yes, you had ordinary share capital worth 20 million. But the question tells you these stakeholders decided to cancel the old shares and to replace them with new shares. Suppose the question told you that the company or the stakeholders agreed to cancel these old shares and replace them with another 2 million shares of shillings 8 each. So what do? We are saying with the amount which we are writing off, we are cancelling the old shares and replacing them with the new ones. And so we are saying to cancel these old ones, you will debit share capital again. You will credit capital what? Capital reduction by how much? By 20. And then you will credit this account we are calling capital what? Capital reduction by how much? By 20. Of course, you will come and say your ordinary share capital 20. So when you debit share capital and you credit capital reduction, you have cancelled the old shares, meaning with the nominal value of the old shares, you have debited share capital and you have credited capital reduction. Then the question told you they decided to replace them by issuing another 2 million shares of what par value? Now 8 shillings. So it means they are issuing shares worth how much? They have cancelled the old shares. They are replacing them with another 2 million shares of 8 each, which means they are issuing another shares worth how much? Obvious, they are issuing shares worth 16 million, which is 2 million times 8, that is 16 million. Now listen, with the nominal value of the new shares issued, with the nominal value of the new shares issued, you will debit capital reduction again. You will debit capital reduction by what? By 16, and you will credit ordinary share capital. And you come and credit capital, ordinary share capital, and you come and say your capital reduction, 16. Now, that is with the nominal value of the new shares issued to replace the old ones. You debit what? Capital reduction, and you credit what? You credit ordinary share capital. If you look at this account, originally the capital was 20 million. We wrote off how much? We wrote off the whole 20 million. Then we replaced those old ones by another bunch of shares amounting to how much? 16 million. So effectively, we are still carrying down 16 million from the original 20 which we cancelled. Now we replace them by issuing another 20, another 16. So effectively, it is like you have written off how much on the ordinary? Effectively, it's like you have written off how much on the ordinary? It's like you have written off the amount of 4 million. It is like you have written off the amount of how much? 4 million. That's what we are saying. So, but you remember, in the original scenario, if you look at the whiteboard, we saw the original share capital was 20 million, which comprised of 2 million shares of 10 shillings each. Then the stakeholder agreed to write off 2 shillings per share, you remember. And so we saw if the company had 2 million shares and each shareholder was willing to write off 2 shillings, we saw they were writing off 4 million. So we said you debit share capital by 4 million. I hope you can see it there. You debit share capital by 4 million, and we said you credit capital reduction. You credit capital reduction. So you can see for here we have written off 4 million. The other approach is where you cancelled the old shares, which were 20, and replaced them with new ones, which were 16, which now we are saying effectively, it's like you have cancelled 4 million. Effectively, it's like you have cancelled 4 million. So we are through with our first entry, which says what? Which says with amount written off on what? On share capital. We are not specifically saying ordinary. It could be preference. But whatever the share capital you are writing off, that amount you are writing off, you go debit that share capital account and you credit capital what? Capital reduction. You go credit capital reduction. That's number one. So let's go back. Now look at number two. Number two, again, you called in the other stakeholders. Maybe you called in the debenture holders. You asked them, what can you do for us? And they said they are willing to write off 5 million from the liability. So number two says, with any liabilities written off, listen, with any liabilities written off, whether the liabilities debentures or creditors, you will go to that liability account. Obvious, you know liabilities are a credit balance. And so if you are writing off whatever you are writing off, you will debit that liability and you will credit capital reductions. That's number two. That with amount written off on liabilities, you debit liability, whichever the liability. I have said liabilities are always a credit balance. And so therefore, to write off that liability, you go debit that liability and you credit capital reduction by whatever the amount. That's number two. Number three. This group of stakeholders, remember they want to eliminate the accumulated losses from the books. They could have also decided, let us revalue some of our assets downwards. As a company, let's revalue some of our assets downwards. So we are saying, number three now, with amount written off on assets, we know assets are always a debit balance. So if you are writing off an amount on asset, maybe machinery, maybe on motor vehicle, maybe on the buildings, whatever it is that the question tells you, we are saying with amount written off on assets, you will go and credit that asset account because it's a credit, it's a debit. So to cancel part of it, you credit. So you go credit that asset and you debit capital reduction, and you debit capital reduction. That's what we are saying. So that is number 3, which says with amount written off on assets, you debit capital reduction and you credit what? You credit the asset, and you credit the asset. That's number 3. Number 4. We have already said a short while ago that the purpose of reconstructing a company is to do what? The purpose of reconstructing a company, we have agreed, is to do what? The purpose of reconstructing a company, we have said, is to help the company to do what? To eliminate what? The accumulated losses. Listen now, we have said the purpose of reconstructing a company is to help the company to eliminate the accumulated losses from the books. Meaning, if you go to the books of this company, in their profit and loss account, you will find an accumulated loss, a retained loss. Tell me this. When a company has been making losses, if you go to their profit and loss account, will you find that profit and loss being a debit balance or a credit balance? This company has been making losses. If they have been making losses, if you go to their account called P&L, will you find that P&L having a debit balance or a credit balance? Yes. Debit balance or credit? This company has been making losses. You go to their P&L account, you will find which balance in their profit and loss. Okay. We are saying it's obvious when a company has been making losses, their profit and loss will obviously have a debit balance. Losses are always a debit balance. So if you go to their P&L account, you will find a debit balance as a brought down. You will have a debit balance brought down. We have already said, listen, number 4, we have already said, or before we talk about number 4, we have already said the purpose of reconstructing the company is to help the company to do what? To eliminate what? To eliminate the accumulated losses. To eliminate the accumulated losses. So to cancel this loss, you will have to go credit profit and loss. You will have to go credit that profit and loss, and you will debit the account we are calling. You will debit the account we are calling capital reduction. You will debit the account we are calling capital reduction by whatever the amount. By whatever the amount. So you go to the capital reduction. We have already credited profit and loss. So let's go to the capital reduction and you debit and you say your profit and loss, whatever. So that's our entry number 4, which says with the accumulated what? With the accumulated losses. With accumulated losses written off. With accumulated losses written off. You will debit capital reduction and you will credit profit and loss. That's number 4. Number 5. Now, this company was trying to reconstruct itself. They have been making losses over a long period of time. They knew you as an accountant, and so they called you to help them reconstruct them. So in the process of you trying to reconstruct, you decide that you will try to gather as much information from this company as much as possible. So in the process of trying to gather information, getting their statement of financial position and so on, you also realize that as at the time I'm reconstructing the company, whichever the time, I also realize as at that time, this company had a contingent liability. This company had a contingent liability. What do you do? That's what we want to find out. But before we find out what to do when there's a contingent liability, of course I know you know what's a contingent liability. What's a contingent liability? What's a contingent liability? It's not a new term to you. You must have heard it before in your profession. So what is a contingent liability? Yes. What is it? What's a contingent liability? Okay. Now, a contingent liability is normally defined. Listen, it is that liability as at the time you are reconstructing, you realize that this company had a contingent liability. So a contingent liability is that kind of a liability which is likely to crystallize in the future. It's likely to crystallize in the future depending on depending on the occurrence or non-occurrence of a future event, depending on the occurrence or non-occurrence of a future event. So we are saying a contingent liability is that liability which is likely to crystallize in the future, depending on the occurrence or non-occurrence of a future event, depending on the occurrence or non-occurrence of a future event. I believe that you should be able to give an example of a contingent liability. Give me an example. We have defined what it is, that it's a kind of a liability which is likely to crystallize in the future. So the question is, give me an example of a contingent liability. Give me an example of a contingent liability. Yes. Yes, I'm waiting. What's an example of a contingent liability? Okay. Now, let us assume that you are reconstructing your company as at the end of the year, which is by the end of the year, I'm assuming 31st December. If by that time you realize that the company had a contingent liability, my question is, if you go to the statement of financial position of the company as at that date, which is 31st December, whichever the year, will you find that amount in the books as a liability? By 31st December, when I'm trying to reconstruct the company, I realize that this company has a contingent liability of whatever the amount. Okay? The question is, if I go to their statement of financial position, will I find a liability of maybe 5 million by the name of contingent liability? Will I find it there? No. So we are saying that contingent liabilities normally do not appear in the books. Listen, contingent liabilities do not appear in the books. Okay? Now, the moment you start reconstructing the company, listen, the moment you start reconstructing the company, that liability, it is required that it should be crystallized. It should be crystallized. That kind of a liability, the moment you start reconstructing the company, immediately you as a company, you are required to crystallize that liability. You are required to crystallize that liability. In other words, make it as a liability in the books. Okay? But so far, you have not given me an example of a contingent liability. Yes? What's an example of a contingent liability? What's an example of a contingent liability? Okay. A simple example that you must have come across before is where you normally have a court case. As a company, by the end of the year, maybe one of your suppliers has sued you, and maybe the lawyer of your company has seen that if the case goes through and it goes against your company, you may be required to pay 2 million, whatever the amount, 2 million or whatever the amount. If the case goes in your favor, then you are not going to pay that 2 million. So it is a kind of a liability which is likely to crystallize in the future depending on the occurrence or non-occurrence of a future event depending on the occurrence or non-occurrence of a future event. So that is an example of a contingent liability, like a court case, which is still pending in court, Listen now. Now, when I was discussing reconstruction, internal reconstruction, I told you all the stakeholders are called into a meeting. If you look at what we had drawn earlier on the whiteboard, we had assumed that maybe we have preference shareholders whom we owe them how much from the question? 30 million. Suppose the company had a 10% cumulative preference shares. The company had a 10% cumulative preference share. Meaning, if the company has a 10% cumulative preference share, then it means every year your company is required to pay them how much as dividend? If the company's amount was 30 million for preference shares and the rate of dividend is 10%. So every year the company is supposed to pay them how much? The company is supposed to pay them an amount of 3 million every year. 3 million every year. Now listen. You know that if a company has been making losses, it is obvious the preference shareholders will not be paid that dividend. But if your company has accumulative preference shares, will they forfeit that dividend? Will the preference shareholders forfeit the dividend just because the company has been making losses? No. That dividend will keep accumulating. It will keep accumulating. So that in the future, if your company makes profit, all the dividends that are still in arrears will be paid. So listen. So if as at the date you are reconstructing the company, the question tells you that this company has not paid arrears for the last 3 years, then you will first be required to know that liability of 9 million is 10% of 30 million, that is per annum, multiplied by 3 years, that comes to times 3, that comes to 9 million. That liability of 9 million, as at the date I am reconstructing the company, if I go to the statement of affairs, statement of financial position of the company, will I see that 9 million in the books? You have not been paying the arrears for the last 3 years. In total, you owe them 9 million. The question is, if I ask for the statement of financial position as at today, will I see that liability of 9 million in the balance sheet or in the statement of affairs? The answer is no. We are saying that that kind of a liability will not appear, or normally doesn't appear, in the balance sheet. But it is a liability that is likely to crystallize. It's a liability that is likely to crystallize in the future. So this is another example of a contingent liability. This is another example of a contingent liability. So we are saying in some questions, you may find the examiner using preference dividends in arrears as an example of a contingent what? A contingent liability. So let's discuss the entry now. Let's discuss the entry. We are still on number 5. We have said, in the process of reconstructing the company, what have we said? If you realize there is a contingent liability, I said you do what? I said you crystallize it immediately. So our entry number 5 says, with any contingent liability arising, as a company, you will debit capital reduction, and you will credit that contingent liability. Whichever it is, you will debit capital reduction and you will credit that contingent liability, whatever it is. That contingent liability, and by whatever the amount. Listen. So we have said if it's dividend in arrears, listen now. If it's dividends in arrears, now you will debit capital reduction with the 9 million you are assuming as the amount of the arrears. And this time, because you know specifically what kind of arrears or what kind of contingent liability it is the preference dividends that are still in arrears, then you now credit specifically the account called preference dividends in arrears. So in most of your past paper questions, normally the examiner uses preference dividends in arrears to be taken as the contingent liability, So we are saying that any contingent liability arising, that's our entry number 5, any contingent liability arising, that contingent liability should be crystallized. How? By debiting capital reduction, and we have said you do what? You credit that contingent liability. Now listen, some questions tell you that liability was paid for immediately. The moment they crystallized it, they decided to pay for it immediately. So if the question tells you that the contingent liability was paid for immediately, then obviously you will debit that contingent liability, whatever it is, and obviously you credit what? You will credit bank or cash, whatever it is that you are using. It could be cash, it could be you're giving them shares as a payment of that arrears, whatever it is. But we are saying if it's paid for immediately, you debit whichever the contingent liability, and you credit either bank or cash, or you credit share capital if you are giving them shares. That's our entry number 5. Okay? Which says, with any contingent liability arising, debit capital reduction, credit contingent liability. If it's paid for immediately, you debit contingent liability, credit bank or cash. I've also said, if you know specifically which the contingent liability is, you open that liability specifically in the name of that liability. We have given an example of preference dividends in arrears. So let's go now to our entry number 6 now. Listen. We normally use our capital reduction account. To help you as a company to implement this scheme of capital reduction. You have come up with a scheme. You want to implement that scheme of internal reconstruction. We normally use this account called capital reduction. Now the point is, once you have implemented the scheme, in most cases, the account called capital reduction should be self-balancing. But there are times when you realize that account is not balancing. Once you have entered the transactions in the account and you are through, then you realize that the account is not balancing. Listen, if the account is not balancing, then that balance that you get in that account is mostly considered to be what we call a capital reserve. And in most cases you find it will be on the debit side of the capital reduction. And therefore you consider it as a capital reserve. And therefore you will debit capital reduction and you will credit what we are calling capital reserve. So that's our entry number 6, which says with any balance in the capital reduction account, that balance should be debited. In most cases we have said it is considered as a capital reserve and therefore it should be debited in the capital reduction and you credit capital reserve. So I've given you the 6 accounting entries for internal reconstruction. Number 1, we have said what? With the amount written off on share capital, what have we said? With the amount written off on share capital, that was our entry number 1. We have said you debit share capital and you credit what? Capital reduction. We have said you debit share capital and you credit capital reduction. That's number 1. Number 2, we have said with amount written off on liabilities, whichever the liabilities, what have we said? You debit what? With amount written off on liabilities, you debit liability, you credit capital reduction. Sour. You debit liability, you credit capital reduction. That was our entry number 2. Number 3, we have said, with amount written off on assets. With amount written off on assets, whichever the asset, we have said you debit capital reduction, and we have said you credit what? You credit the asset. You debit capital reduction, you credit what? You credit asset. That's our number 3. Number 4, we have said with accumulated losses written off. We have said with accumulated losses written off, we have said you debit what? You debit capital reduction and you credit profit and loss. And you credit profit and loss. Now listen. Listen to this now. Most of your past papers will normally not remind you to write off the losses. Most of your past papers will not remind you to write off the losses. They will talk about share capital, they will talk about what to write off in terms of assets, they will talk about which liabilities to write off and so on. But most questions will be silent on the writing off of what we are calling the accumulated loss. But listen, we say when we were starting, the aim of reconstructing a company is to do what? Is to help the company to eliminate what? To eliminate the accumulated losses. Is to help the company to eliminate the accumulated what? The accumulated losses. Okay? So if the aim is to help the company to eliminate the accumulated losses, then it means, listen now, it means that as a company, whether the examiner reminds you or it does not remind you, you must remember that the aim being to eliminate the loss, that accumulated loss must be written off. So somewhere before you close the accounts, you should remember to write off the accumulated losses. I've said most questions will never remind you to write off the losses. Most questions will never remind you to write off the losses. So it's your responsibility to remember that you should write off the losses. That was number 4, which said with accumulated losses written off. You will debit capital reduction, credit profit and loss. That was number 4. Number 5, we have said with any contingent liability arising, e.g. which one? E.g. preference dividends in arrears. With any contingent liability arising, e.g. preference dividends in arrears, we have said you debit what? You will debit capital reduction. You will debit capital reduction and you credit that contingent liability, which specifically now we are saying it's preference dividends in arrears. Then we have gone further, still under number 5, we have said if the liability is paid for immediately, then we have said you will debit that liability, which is contingent liability, debit that contingent liability and credit bank. And you credit bank. That's number 5. Number 6 and the last one we have said that if there's a balance in the capital reduction account, that balance we have said should be considered as a capital reserve. And therefore we have said you debit capital reduction and you credit what? You credit capital reserve. Okay? That is all for the accounting entries in the books of, in the accounting entries for internal reconstruction. Now, before we do an example, I want to ask you a few questions. And the questions I want to ask you are based on the entries we have already mentioned. Number 1, we have said, with amount written off on share capital, we have said you debit. We have said you debit what? We have said you debit share capital and credit what? Capital reduction. I hope you can see that's where we did it. Okay? We said you debit ordinary share capital and you credit capital reduction. Listen to my question now. When your company decided to write off 4 million, the shareholders agreed to write off 4 million and we debited share capital by 4 million, and we credited capital reduction by 4 million. The question is, to us as a company, is that a gain or is that a loss? To us as a company, is that a gain or is that a loss? We have said, you called in the shareholders. They were willing to write off 4 million. So you as a company, you debited share capital by 4 million. You credited capital reduction by how much? By 4 million. Question is that a gain to the company or is it a loss to the company? What have you concluded? It's obvious that amount is a gain to the company. Why? Because now as a company, you have reduced what you owe as a company. You have reduced what you owe to who? To the ordinary shareholders. To the ordinary shareholders. Follow now? That's number one. Number two, we said, with amount written off on liabilities. What did we say? With amount written off on liabilities, what did we say? We said you debit what? You debit liabilities, and you said we credit capital reduction. That was this one. You can see it there. We said you debit liabilities, you credit capital reduction. That was number two. Now, question is, we called in the debenture holders. They were willing to write off 5 million from their amount. So we went and debited debentures. We credited capital reduction by whatever the amount. Question is that a gain to us as a company or is it a loss to us as a company? Gain or loss? To us as a company, is it a gain or loss? You called in the debenture holders. They were willing to write off whatever they were writing off. So you debited that debenture account or whichever the liability and you credited capital reduction. To us as a company, is that a gain or a loss? Yes, it is obviously a gain. Why? Because again, as a company, you are reducing what you owe to the debenture holders or to the creditors. And that's why we are saying that is what you did. So you debited liability, you credited capital reduction. That's what you did there. Okay. Number three, we say with amount written off on assets. What was the double entry? With amount written off on assets, we said the double entry is you debit. We said you debit capital reduction and you credit what? Assets. Question is, to us as a company, is that a gain or loss? To us as a company, is that a gain or loss? It is obvious it is a loss to us as a company. So when you debited capital reduction with the amount you wrote off on assets, that is a loss to the company. So you debited capital reduction, you credited the asset. That's a loss. Let me ask another one. Before we reconstructed the company, in our books, we did not have a contingent liability. Listen, before we reconstructed the company, we did not have, in the books, we did not have a contingent liability. But we have said, immediately you start reconstructing the company and you come across a contingent liability, that liability we have said should be done what? Should be crystallized. That's what we say. And how did we crystallize it? We had to make it as a liability. And we ended up debiting capital reduction. I hope you can see it there. We ended up debiting capital reduction and we credited contingent liability. You can see in the next page, that's what we did. We ended up crediting that contingent liability. Now listen to the question. When you debited capital reduction and you credited contingent liability, in other words, before reconstruction, we did not have a liability in the books. After reconstruction, now we have a liability in the books. Is that a gain to the company or a loss to the company? Is that a gain to the company or a loss to the company? It is obvious, I hope you have noticed, that that is a loss because we didn't have a liability before. Now we have a liability as a company, and therefore we have a loss. We realize a loss. So we are saying that is also a loss. Now, from those 4 entries I've asked you, listen, from those 4 entries I've asked you, I hope you have noted something as I was taking you through this account called capital reduction. As I was taking you through this account called capital reduction, I hope you have noticed something. What have you noticed? What have you noticed as I took you through the account called capital reduction with those 4 entries? When I was asking you whether it's gain or loss, what have you noticed? What have you noticed? What have you noticed? Now listen. I hope you noticed that every time our company made a gain, that gain, where did we take it? In other words, did we debit capital reduction with that gain, or did we credit capital reduction with that gain? Any time we made a gain as a company, we debited capital reduction or we credited capital reduction. What happened? We obviously did what? Credited. You remember, we saw when liabilities are reducing, that's a gain. We saw when capital is reducing, that's a gain. Another thing you should have noticed is, anytime we made a loss, listen, anytime we made a loss, that loss was ending up being debited. That loss was being debited in the capital reduction. I hope you noticed that also. In other words, for example, with the amount we wrote off on assets, we said it's a loss. We ended up debiting capital reduction. When there was a contingent liability and we crystallized it, we saw that's a loss to the company, and therefore we ended up debiting capital reduction. So in summary, I want to believe you have noticed that whenever there is a loss made, whenever there was a loss made, that loss was being debited. Where? In the capital reduction. That loss was being debited in the capital reduction. And whenever the company made a gain, that gain was credited where? In the capital reduction. In the capital reduction. That's what we are so hoping. Now, the reason why I took you through is this. In your exams, there are times when an examiner may give you a transaction, maybe as a note number 7, note number 10, and that transaction is not among the 6 transactions I've given you, is not among the 6 transactions we have discussed. Meaning, it's not amount written off on share capital, it's not an amount written off on liability, it's not an amount written off on assets, it's not an accumulated loss, it's not a contingent liability, and it's not a balance in the capital reduction. Yet you realize, listen now, that transaction the examiner has given you, in the process of trying to implement that transaction, you realize that as a company, we shall suffer a loss. The point is this, or the question is this. Now that by trying to implement that transaction, your company will make a loss, should we go and debit that amount in the capital reduction, or should we go and credit that amount in the capital reduction? What will you do? It is obvious you will go and debit that amount. Now listen. So an example of such a transaction that most examiners are fond of giving you, they may tell you something like this. Listen, that in the process of reconstructing the company, our company incurred a reconstruction cost. Your company incurred a reconstruction cost of shillings, maybe 2 million. 2 million shillings was incurred in the reconstruction of this company. So if we spend 2 million to reconstruct the company, it is obvious that's a loss to the company. So you will debit capital reduction by 2 million, and of course, because we are spending 2 million to reconstruct the company, you will credit bank. You will credit bank. So that's a double entry for that kind of a transaction. It's not among the 6. But we realize that in the process of trying to implement the scheme, in that note, number 7 or number 10, That note, by us implementing it, we realize we shall suffer a loss. That loss, I've said, should be debited in the capital reduction, I've given an example where you are told that reconstruction cost of shillings 2 million to be incurred or was incurred. So we are saying you debit capital reduction and you credit what? You credit bank. What if you are told by another note somewhere, share premium to be written off? Share premium to be written off. It's not among the 6 entries we have discussed. It's not among them. So, what do you think? By writing off that share premium, will it give us a gain or make us to have a loss as a company? If you are told share premium to be written off, shall it give us a gain or shall we end up making a loss? What do you think? It's obvious, you know, share premium is money that belongs to who? To shareholders. Share premium is money that belongs to who? Shareholders. So if you are writing off that share premium, listen, if we are writing off that share premium, we know share premium is a credit balance. Share premium being a credit balance, and we are writing it off, then obvious as a company, we are going to gain. As a company, we are going to gain. Why? Because by writing off the share premium, we are reducing what belongs to the shareholders. So we shall debit share premium to write it off. We shall debit share premium and we'll credit capital reduction. And you'll credit capital reduction by whatever the amount of what? By whatever the amount of the share premium. By the amount of the share premium. So I've given you in general how to know which items to debit in the capital reduction and which items to credit. In summary, we have said any loss that a company makes in the process of reconstructing the company, that loss should be debited. That loss should be debited in the capital reduction. Then I've said any gain made in the process of reconstructing a company, that gain should be credited in the capital reduction. Okay? So I am through with the area of internal reconstruction. We have said for internal reconstruction, the stakeholders are called into a meeting. Okay? They tell us what they are willing to sacrifice: ordinary shareholders, preference shareholders, debenture holders, creditors, and so on. Then once we agree on a scheme, then we go implement on that scheme with the amount written off on share capital, with the amount written off on liabilities, with the amount written off on assets, with any accumulated losses written off. Then we have said with any contingent liability arising, what do you do? And finally, if there is a balance in the capital reduction account, what do you do? The other key important point we have said is the examiner will never remind you to write off the accumulated losses. He will never remind you to write off the accumulated losses. Normally, that's your responsibility. Normally, it is your responsibility. So for now, that is all. I have no time to do a question now. We can stop there for today. Next lesson, I now start a question on internal reconstruction. We shall be able to do a past paper question from your past papers now on internal reconstruction, where we shall apply the information we have learned today and of course any other item. So maybe for now we can stop there. And we pick it up from there next time. So see you next lesson. Okay. Bye.